Recording in progress. Welcome to Trading the Markets. My name is Mitchell Joseph, and I'm going to go over market capitalization today. So what's up, guys? Today we're going to go over market capitalization and sector rotation. So we're going to continue off of what we learned last time and build upon it. So give me a second. Let me get started. All right. All right, I'm gonna share my screen. Let's see, make this smaller. Let's see. All right. So last time we were talking about the 11 sectors of the stock market. We were talking about how tech is the biggest piece, and how they all have different weights in making up the total stock market. But today I want to take it a step further and talk about the market capitalization. Okay, so let's start here. So market capitalization. So you probably heard people say market cap, So market cap is the total amount of money that a stock has. If you count all the shares, you add them all up, you count every single share and you add them all up, that's going to give you the price tag of how much the whole company is actually worth. So that's what we call it on market cap. So it's not just the stock price, it's about how many shares they have, because if you add it all up, that's going to tell you the real size, because the stock price alone does not tell you how big the company really is. All right? And it's not based off the amount of cash that a company has either. So how do you calculate this? So you take the share price and you multiply it by the total number of shares. So let's just say it's $50 a share, and this company has 100 million shares. You basically would multiply it, and 5 billion would be, if you took all the shares and you calculated the total value, that would be 5 billion. So that would be the market cap of all the shares. All right, any questions? You guys got questions, let me know. I'm gonna go right through it. So yeah, so shares outstanding, that's the total number of shares that's owned by investors when you see that language. So for example, right, let's just say you got ABC company, they're $50 a share and they have 100 million shares. So like I just said, another example, that equals a $5 billion market cap. Meanwhile, you might have company XYZ, that's $800 a share. So you might look at like $50 a share, $800 a share. The $800 a share should be way bigger, but not necessarily how many shares do you got. So this $800 a share company only has 10 million shares versus the $50 share company has 100 million shares. So if you do the math, 800 times 10 million gives you 8 billion. So company XYZ is only a little bit bigger than company ABC. But if you look at the share price, you would have been fooled thinking that it's so much bigger, but it's not. So some more examples. This is all showing you, why share price doesn't determine. So, oh yeah, the key lessons. A higher stock price does not mean a larger company. That's what I've been saying. Yeah. So then this one. So company A is $20 a share, but it has 2 billion shares. So their market cap is 40 billion. Company B has $500 a share, but only has 20 million shares. So even though company B is $500 a share, it's still smaller than company A. That's $20 a share. Because when you multiply all the shares by all the money per share, you see who's really bigger. So if you look at it, company A is 4 times bigger than even though it has a lower share price. All right, any questions? You guys following me? Just let me know, slow me down. So we have to learn the different categories, the different sizes. So you got the nano caps, which is tiny, super penny stocks, under 50 million. And that's one thing you got to realize, the stock market is so big. Like, to be a company on the stock market, you got to already have been making millions upon hundreds of millions, maybe even to billions. So when you look at it, under 50 million is tiny. Micro, that's still tiny, but that's 50 million to 300 million when it comes to how many shares they have. Oh no, actually no, the total market cap. So that's the total amount of money that all the shares add up to. Small cap is 300 million to 2 billion. So small cap That's the penny stocks. That's the little Fords, little companies that tend to be under $10 a share or under $20 a share. You could say mid cap. That's your, mid-sized companies, your banks. A lot of times, depends on the bank though, but that's 2 billion to 10 billion. So until you start, so basically anything that's less than 1 billion market cap is a penny stock. So you got to at least hit the billions in order to at least be something, right? So then you have the large caps, 10 billion to 200 billion. Then you have your mega caps, which is over 200 billion. Then that's where you go into companies that have trillions, like Apple, Microsoft, Nvidia. These companies, their market cap is in the trillions. So it just shows you like the scale. Like you gotta understand, where you are in the grand scheme of everything that's going on. Then you got the small caps. So yeah, so small caps. I personally do like small caps. Or did I miss anything? Yeah. So small caps, they're usually younger companies. Your startup companies might be small caps, but you can also have companies like Ford that have been around for a long time, but they're very cheap and they're a small cap company. So there's pros and cons. The small caps, they have bigger growth potential. So the smaller you start, the bigger your growth potential potentially is. So also with the small cap stocks, you'll also know that they have a higher volatility. So it's greater risk, but you also have a greater reward potentially. Because when you start small, it's easier for a company to go from $1 to $2 than it is to go from $100 a share to $200 a share. Just when you see the growth, is it because you're starting so small, every bit higher is so much more growth. What's going on, Chris? Thanks for tapping in, Mike, Chrissy. So mid caps, they're established, but they're still expanding. And you'll notice that they kind of give you a balance. So think about it. It's like an extreme, right? You got the small caps over here that are more risky but more growth potential. But then on the other side, you got the large caps that tend to be more stable but won't grow as fast. You know what I mean? So then you got the mid caps right in the middle. They give you a balance of growth and stability, and they're attracting long-term investors. So people that want to be in the middle, the mid caps for you. Then you got the large caps. Those are the well-established companies. They're more stable. They have earnings. They often pay dividends. So these are the big global leaders in the stock market. When it comes to large caps, like your Morgan Stanleys, your Goldman Sachs, like usually the bigger ones. But then there's a level above that, which is the mega caps. That's where you go into your Microsofts, your Nvidias, even your indexes like the S&P 500 and Dow Jones. These are considered mega caps, but those are indexes. But there's certain stocks that are big enough that they're considered mega caps. Once the market cap goes over 200 billion, then you become a mega cap. All right. Think about the largest businesses in the world. So why does it matter? It matters because it measures the size of the company and helps you when comparing companies. You can't just compare, oh, this is a $50 share stock, there's another $50 share stock, let's compare them. No, because depending on how many shares each one has, one might be a large cap, the other one might be a small cap. So you really have to see the big picture, and this is why it's important to understand the difference between the caps. So again, small, high growth, high risk. Mid, balance in the middle, and then large is stable, mature. Mega, global leaders, slower growth, but they're not going anywhere. All right, so then from here, I wanted to do a quick lesson on the sector rotations. All right, let's get into this. So remember last week we talked about the 11 sectors of the stock market, and it was basically just like, I think I have that animation right here. Yeah. So this was the 11 sectors of the stock market. You got your tech, materials, real estate, utilities, communications, consumer discretionary, consumer staples. So I understand consumer staples is the stuff that you need, and the consumer discretionary is the stuff that you want after you paid all your bills. The money that's left over, that's discretionary. Then you got your energy, financials, healthcare, and industrials. So now within those sectors, they're also classified and broken down even more. So you can break them down into three groups, essentially. You got your defensives, you got your growth, and you got your value. So how money flows between the sectors, that's something for you to really pay attention to. So basically money, the hedge fund, the big funds that invest people's money, they don't usually take money out of the market. They just rotate it around. So if tech is doing good, they'll sell top tech, and they might put it into defensives. Defense is doing good, then they sell that and they put it into value. So his money's being circulated around the market all the time. So this is called the sector rotation, you know, and it can shift based off the conditions of the economy, interest rates, predictions. So the goal is to own sectors that's likely to outperform whatever's going on now. So depending on the condition of the market, one sector will be leading, one sector will be lagging. So like I said, money's always moving, never leaving the market, but rotating. So, like I said, you have growth, value, and defensives, and think of them as different tools that you want to use in different market environments. So let's talk about growth. Everybody's favorite, growth. Everybody wants to grow their money. Everybody, so these companies, they grow earnings fast, which means that as a company, they make money, they make profits, and they like to share those profits with the people that buy the shares. So they have quick earnings, and they usually reinvest profits. Some of them pay dividends, but they like to just keep growing their company, right? So examples is Nvidia, which is Nvidia is the biggest stock in the stock market right now. That does change from time to time. Sometimes between Microsoft, Apple, and Nvidia, but I'm pretty sure Nvidia is number one. If I'm wrong, you guys can let me know. So then you got Amazon, Tesla, Meta. These are growth. They give you high return and fast revenue growth. So they're faster. They're the engine that really pushes the market. But at the same time, they're more volatile, which means they move like this more. So you might be up one moment, down the next, up one. So they're also more sensitive to interest rates. So those are the growth stocks. Those are the growth sectors. So when money is rotated into growth, the economy is booming and everything is just on 1,000. Value. So value stocks, they're usually companies that people feel like they're undervalued. So they're not trading at what people believe they're worth. So some of these include J.P. Morgan, Pfizer, Ford, Berkshire Hathaways. So they have lower valuation. So when people look at them, they feel like they're not valued what they're actually worth, and they often pay dividends. So dividends is when you buy a stock, and whatever extra money that company makes, they pay it back to you in the form of a dividend, which is basically interest for holding the stock, you could say, right? So these have slower growth, and they can also stay undervalued. Defensive stocks. So businesses that people use regardless. So whenever the economy is struggling, you're gonna buy them anyway. Toilet paper, you gotta buy that anyway. Food, you're gonna buy that anyway. So you got your WalMarts, you got your Johnson and Johnson, Coca-Cola, Procter and Gamble. These are stuff that's gonna hold up no matter what's going on, and especially when the economy is struggling or in a recession or depression. These are the companies that's gonna hold up the most. So, but at the same time, when the market starts pumping, they're also gonna go up very little. They're not gonna go up as much as growth. So when the market is doing good, growth is booming. When the market is struggling, defensives tend to get a bid, and then when the economy is recovering, value picks up the slack. So here you go, growth, highest risk. Value, moderate growth, attracting pricing, and defensive, lowest volatility, so it doesn't bounce as much. So you got a little bit more stability, but it has more to prove, you could say. So what drives sector rotation? Stuff like economic growth, interest rates. So if you guys don't know, the Federal Reserve, they are in charge of setting the monetary policy of the United States. So they decide whether or not we're going to raise the interest rate, we're going to cut the interest rate, or we're just going to just keep it the same. They decided that. So inflation, when you see so the Federal Reserve, their job is to lower inflation and to lower unemployment. So they're always fighting inflation and unemployment. And inflation is just like when you see the cost of something next year being more than it was the year before. So let's just say the same water bottle was $1. and then next year this is $1.25. It didn't change the value of this didn't really change. It's the price change because it costs you more money to buy the same things. So that's why you see Federal Reserve policy, and you see corporate earnings, and you see investment sentiment. These are things that affect sector rotation. So, like I was saying, when the economy is in recovery, you want to be in financials and industrials. Once it starts booming, expanding, you want to be in growth. You want to be in tech. You want to be consumer discretionary. When it slows down and struggling, healthcare, utilities. These are also defensives. And number 4, recession. These are also defensives too. Consumer staples and utilities. All right. So putting it all together, identify what kind of economic environment are we in. Then you determine what kind of stock styles will benefit that environment. Then you focus on sectors that actually historically outperform. So then you manage risk, and then that's how. If you're, let's just say, if you wanted to build a stock portfolio, you want to have growth with the defensive, so that when the growth is up, the defensive might not really be doing nothing. But then when the growth is down, the defensive is up. So they kind of balance each other out. You want to be balanced so that you always have one side that could carry the other. All right. So that's that. Let me know if you guys have any questions. So we did that. We did that. Yeah, we talked about market cap. All right. So now let's go into hold on. Let's go into some other stuff. So last week we were talking about identifying the trend. Let's see. Yeah, all right. So yeah, we were talking about identifying the trend. We know that it's a downtrend if the highs are getting lower and the lows are getting lower. And we said it's an uptrend if the highs are getting higher and the lows are getting higher. You can clearly see that. But then it's in the balance trend when you can't see one clear side winning and it kind of goes sideways in the middle. That's when you have the balance trend. But all in all, when you are looking at the market, you want to look at where is the floor and where's the ceiling. And then we were talking about last time how the floor and ceiling isn't always isn't always horizontal. It's also diagonal at times. So you have to train your eyes to see it, to look for it. But once you train your eyes to see it, once you see it, you can't unsee it because you end up getting used to it. Um, we're talking about reversals because reversals, like me primarily as a trader, I love trading reversals. They give you the best risk to reward where you're risking so little to potentially make a much bigger reward. So the whole point of it was this, right? So let me do a little annotation too. So as you see, the market's on a downtrend, right? Because the highs are getting lower and the lows are getting lower. See how the highs are getting lower and the lows are getting lower? But look what happens right here. Once you make this last lower low and last lower high, then it shifts and this low is higher this low. Remember, this low is lower than this low, but then this low is higher than that low. So then the lows start to get higher and the highs start to get higher. So this is the moment where you see the reversal starting, and once you see the lows getting higher and the highs getting higher, you're right there. You're on an uptrend now. So that's how you know based off the market structure where you are and how to position yourself to take advantage of what's coming up next. So erase that. So we talked about that. So now I want to go over some terms. Let's see which terms. Hold on. Don't want to get too complicated yet. Where's the terms that I was looking for? Okay. Okay. So let's talk about some of these terms. All right. So I was letting you guys know bull market, bulls go up, bear market goes down. That's pretty simple. So now the markets. So we have international exchange and we have NYSE, that's the New York Stock Exchange, and CME, Chicago Mercantile Exchange, and the CBO, Chicago Board of Trust. So these are basic. The exchange is basically where the buying and the selling occurs, and your broker is the one who actually facilitates that process. So then we're talking about, okay, volatility. Volatility is how fast, so it's how fast and how big the swings are. Something is moving, and liquidity is just how easily, like, is there enough buyers and sellers, or am I going to go in there and I'm the only buyer? If I go in there and there's not a lot of buyers and sellers, guess what? It's hard to get in and out easily. But if there's a lot of buyers and sellers, that means it's liquid and it's easy to get in and out. So when you're choosing what to buy, you want to make sure that there's enough buyers and sellers to support whatever amount that you're getting. So gap up, so that's when the next day the stock opens up higher than when it closed the day before. Gap down is where the stock opens up lower than where it closed the day before. So yeah, so when you hear people say going long, they're betting it's gonna go up. When you hear people say going short, they're betting that it's gonna go down. All right, so let's talk about trading. We're talking a little bit about trading. So day trading, that's when you buy and sell that same day. That means I'm not holding it overnight. The same day I get in is the same day I get out. That's day trading. That can also go into scalping. Scalping, I didn't put it on here, but scalping is like day trading, except it's even shorter. It might be minutes, versus day trading could be hours. Swing trading. So once you hold something overnight, you're swing trading. All right. So that's really it. Real simple. It could be as simple as one night. It could be as simple as 1 week. It could be as simple as it could be a month, maybe a few months, right? But once you get to say like about a year out or close to a year out or the next calendar year out, that's what you call a leap. A leap is a longer term option typically has about a year of expiration or more on it. All right. Okay. So now when it comes to orders, there's market orders and there's limit orders. So market orders, so let's just see. So remember, the market is a market. It's just like if you go to farmer's market, right? And you want to buy some, pretend these are a drink, right? You want to buy this drink from the market, right? Now, the person selling you is going to tell you, oh, $10 to buy this. And then you might be like, nah, I'll give you $5 for this. And they're like, nah, $9. And they're like, nah, $6. And then guess what? You buy this for $7. The same process is exactly what happens in the stock market. People are bidding on prices all day long. Like, that's one thing we don't think about. We see the prices, but we don't realize if you were to go back to, I don't know, 80s, 90s, you'll see someone in a trading pit where they're getting orders and everybody's yelling at them. And it's just like if you go to auction, like, let me get for $5, stock 100. Like the people that speak really fast at the auction. That's literally the same thing that's happening in the market. They're advertising prices. It's called a market because it's marketing prices for you to get in. So just so you understand. So if you buy something at the price that you see in the moment, that's called a market order. Now, you don't always have to get in that way. Let's just say you see that this stock is advertising for $10. You could set a limit order and say, okay, I want to put in an order for $7. If it ever drops down to 7, it'll get me in. All right. So market order doesn't guarantee the cheapest price possible. You should avoid. If it's not liquid, you don't really want to trade it. So limit orders, that's what I was telling you about. It gives you control on how much you're paying. You choose the price that you want to buy or sell at when you do a limit order. And stop loss. Okay, so when you enter the market, you can set a price that if it drops below, the market will automatically kick you out and give you the money back that's left at that point. All right. So I think that concludes the lesson portion. Anybody have any more questions? We can get into market conditions, what's going on now, ideas, trades, stuff like that. So if Chris, Mike, you guys want to look at anything, we can. But this concludes the lesson portion. Let me know. I'll pull up some trade ideas for you guys. Give me 1 second. Yeah, and if you guys want me to look at something, let me know. Let's see.
Nothing to look at.
Okay.
Just
Well,
YOLO long tech.
okay, let's look at this tech. Let's look at the sectors that way. Okay, let me do it. I got you. Let's see. Go to my watch list. Where's my sectors? Okay, I'm gonna look at the sectors. All right, so over here are the sectors I have on my watch list on the right. So XLC, let me take out some of these things just to make it look cleaner.
DRAM.
DRM.
Yep.
All right, let me just take this out. I'll leave. So this line, the black line, I'll leave it on. That's a 200 moving average. So it just averages out the last 200 bars and kind of gives you an average on whether we're going on an uptrend or a downtrend or whatever. But you said DRM. That's the memory, right?
Yeah, the thing that goes up every day.
Yep.
Forever.
Wow, this is the memory ETF. So clearly you guys can see this is an uptrend. How the lows are getting higher and the highs are getting higher. Now, if we were to look at this, let's try to draw where's the floor and where's the ceiling. Very easy. Here's the floor. I'll use a box. So I can use a line, but the only reason I'm using a box because even when I draw a line, it's not an actual line, it's a zone. So that's why I'm using the box to show that it's not just a set line. So this was what I would call the floor, right? And then up here, this is clearly your ceiling right here. You could argue there's multiple floors and multiple ceilings, but just using the extreme highs and lows, these are the floors and these are the ceilings. So right now you can see we're in a range since Friday between 55.80 and 69. Let's call it 70. So between 55 and 70, we're ranging right now. So we're in the middle of the range. So can you, Mike, can you tell me the holdings inside of DRM? Like, what are some of the stocks inside of it?
Samsung, SK Hynix, SanDisk, Micron.
SNDK. What's the ticker? SNDK, SanDisk?
Yeah.
Yes, SNDK. So let's SNDK. Oh, I think I typed that in. SNDK. All right, so this is scan this. So as you can see, this is one of the leaders inside of memory. So we see like this company, and let's say you didn't know, right? And I didn't have Mike to ask. I could always just look it up and go Google
Stock analysis is good.
stock analysis.
Yeah.
What's that website?
Well, if you do DRAM holdings, it should be one of the first things that come up.
Okay, I'll just do that. TRAM holdings. So yep, like you were saying, SanDisk, Samsung. So DRAM. This is the ETF. Remember, ETF is a basket that holds a bunch of stocks inside of one name, one basket. So inside of this basket, you got SanDisk, you got Samsung, and you got Micron. Okay, Chris. I remember when Chris was trading that. SK Hynix. Not familiar with them, but they look like between them and Micron they're the biggest holdings. So let me look at Micron.
Yeah, you can click on the link Round Hill Investors.
Like
So if you go,
on the same page on this page or on
yeah,
right here?
right there. So
Okay.
Round Hill Investments. You see the two links? Yeah,
Oh yeah,
it'll bring
yeah,
that
yeah.
up. Just scroll down a little bit.
Good looks. So yeah, so right here you see the top holdings. Well, all the weight. It got South Korea. Oh no, that's underneath. I wonder why they have New Taiwan and South Korea on this list. And then you see the performance. So this has been a hot sector right now, which is memory. So the question is, are, are we still? Is the sector still going to be hot? Because at the same time, I remember seeing software has been beaten down. So maybe we might get a rotation to software. It's just an idea. What is software? IGV, right? IGV. So IGV is the software. So look, software's been getting beaten down. So if memory starts to slow down, potentially they may rotate that money into software. And you guys trade software?
Oh yeah.
Yeah. So what's the top software name? Intel, IBM,
Sorry.
like IBM software.
What'd you
Yeah.
say?
I was looking at what the top holdings in IG in software were. I could just look it up too.
Microsoft is the biggest one.
Microsoft.
You got CRM, I believe,
Yep.
Palantir,
Oracle,
Adobe,
Palantir.
Oracle.
Yep. So let me look at Oracle. So Oracle, I've been watching Oracle, and this has been being down, and potentially if we get rotation into software, this might go back up to the 250s, 240s. So
Yes.
this is one I'm gonna keep my eye on because I like trading Oracle, and what's the other one? Oracle. I can't remember the other one that I like to trade. Remember the one that has it has a leverage ETF. Was it Oracle? CoreWeave? Oh,
You
CoreWeave.
also have app in there. You guys hear me? Is there an echo when I'm talking?
No, I can hear you clearly.
Okay, cool. But yeah, app is another good one. Palo Alto's in there, CrowdStrike.
Mm-hmm.
Yeah, some of the cybersecurity names. Yeah,
Yeah, app.
Microsoft, like Mike mentioned.
So,
I don't think Oracle's ready yet for calls, man. But yeah, I do like those two. I would say 240s, 250s, maybe 230s. But it's just not. It's really not right there. It's not
it
at the
hasn't
top
proven
where
it
you.
hasn't proven itself yet.
Yeah, they just came off a good run, so it's kind of like cooled off for a little bit. So it's just kind of not ready for calls yet.
Okay, but looking at the other ones, it's an app. He said Palo Alto. Um, I don't remember what the ticker is for Palo Alto. The PNW.
PANW
Yep,
or
yep. Oh, this one has proven itself. This one looks strong. It's holding at the highs. I know there's like a the fair value gap right there.
yeah.
So potentially, if this were to come down, it might set up. Like if this could do something like this, even come down and just hold. I wasn't trying to keep going. I was trying to finish doing this. But potentially, this could do something like this, or this is what I would be looking for it to do. Maybe it might go a little deeper, but potentially it might do something like this. And inside this yellow box, if it starts to come back up, that could give you a good entry to potentially ride it back up. Or maybe it's ready to go now. I don't know, but this would be an ideal way that I would want to catch it would be to see if we can get a pullback. But we'll see. What do you think, Chris?
Yeah, I had to get off mute. I mean, the chart looks good. Just looking at the day chart, it's got
Mm-hmm.
full time frame continuing. So like if you go to the far left, far scroll down under where it's got the information for Palo Alto.
Down,
Yeah,
like
just
down here.
scroll. Yeah, and then scroll down. You'll see the full green. Scroll back up. So yeah, you
Oh,
see all
right
the
here,
greens there.
weekly.
Yeah.
Okay.
Uh-huh.
Oh, I
And
never.
then also you got a price target on here. Well, what is showing on Trading View? If you scroll down, I think it's like 320, something like that for 1 year, probably 1 year average price target. So there's a lot of good things going on with it. Did beat earnings top and bottom. I mean, I have to look into like the what's going on with the company as far as the guidance and things like that. But just looking at what I mentioned so far and everything, it's
Seasonals and
not something I
stuff.
typically trade, but this would definitely be something that I would keep on the radar. Maybe something in that area around uh like probably 280 something. What is that? Let me go. Let me pull up the chart myself. Hold on.
Okay.
Uh,
And then I'll look at this on the other time frame, on like the 4 hour,
two.
1 hour.
I don't know. Maybe kind of 288, 285, 288, maybe something like that. We could run it way back. We could run it up to back when it was June 1st. So the high on that was what 302.
Yep.
So my price targets on this would be based off the chart, right? Which is going to be limited. Would be Monday June 1st and then Monday June 2nd. So I'd be looking at like 302, 299, somewhere around there. And I'd probably be looking to get, if I was going to get in, I'd probably be looking to get in somewhere around that candle on the third. So
Okay.
probably where it opened / the high of that candle, somewhere around there. So that'd be somewhere around 284, 288, somewhere around that range. I'd be looking at probably getting in.
So you'd be waiting for it to basically break the recent highs?
Well, I mean, as far as price targets, as far as me being already in, but
Oh,
if I was looking just based off this chart without knowing more about the company and projections and stuff like that, based off this chart, I'd be looking to get in somewhere on that June 3rd candle. So probably the opener of that, which would be was that about 285, somewhere like that.
Yeah, right here. Yeah,
Yeah, but it looks good though because you got that bullish fair value gap.
So,
And then we'll see what happens tomorrow. Most stocks, I think, they're gonna get a jump. But I like looking at that weekly. So, and then also too, not only do you have the bullish fair value gap, but you also have that weekly open 269 is the weekly open 269.63. So long we keep staying above that, we're bearish, right?
all right. So
Bearish
so
with bullish
this
fair
so
value gap
this
in
is
the
gonna
weekly.
shut down in less than a minute. So I'm gonna log out. If you guys want, I could log right back in the same link right now for whoever wants.
Yeah, let's hop back in.
All right, let's do it.
Okay, cool.
All right.